morning, everybody. Welcome back to our second session on cyber agent threats. We have a panel discussion today. I'll be moderating very lightly because I think we probably don't need too much moderation between this crowd and these panelists. But I've been speaking to them beforehand, and I think it's going to be an interesting session to start. The two people on my left, they'll present first, and there'll be some time for question and answers while they're doing it. I don't think either of them is afraid to take questions if you have them as we go. And then we'll leave some time at the end to get into some more specifics about topics that might be specifically interesting to the room. On my left, Mr. John Boykin with Bramhall and Hitchen Insurance, talking about some of the liability threats, cyber cases. And further to my left, Mr. Matt Powell, Senior Vice President at Citibank, who we were just talking outside about some of the high-tech and very low-tech ways you can steal money and how he wants to prevent you from doing so. Both, I think, will be interesting speakers. So thank you both.
Thank you. Thanks, everybody, for being here. Starting mine, just a little bit about me. Vice President and Senior Advisor with Bramhall and Hitchen. We are an independent insurance agency in Newark, Delaware. We strictly handle commercial property and casualty insurance. I hold my Certified Insurance Counselor designation, as well as my Professional Work Comp Advisor designation. And what I'm going to talk about today is cyber agent threats to your business. So the whole cyber liability and data breaches is a portion of that, but there's also a few other modern day threats that we see claims arising from these days that I wanted to address as well. First is employment practices liability. Second is directors and officers liability. 3 is workers' compensation. 4 are employee dishonesty situations. And again, 5 will be privacy liability. So starting off with employment practices liability, this deals with liability coverages for suits alleging any type of wrongful termination, harassment, discrimination, unlawful hiring processes, really anything that deals with the employee-employer relationship. So these types of claims have been on the rise for the last few years, and we're seeing a lot of situations where claims go uncovered. Many people think this is covered under your standard commercial general liability policy, when in fact it is specifically excluded, and a separate policy must be purchased to do this. The policies can also be endorsed to cover third-party scenarios. So again, an unendorsed employment practices liability policy covers the employee-employer relationship. What we really recommend doing is also covering it for third parties. So in a scenario where a supervisor makes a comment to a subordinate, that type of scenario is already covered. But what happens when the UPS driver comes in and makes a comment to the receptionist up front? What happens on a construction job site when one of your employees makes a comment to a subcontractor? Those types of scenarios are uncovered. So we always recommend having the policy endorsed to cover the third party as well. And what we are covering with this type of policy is not just any damages that were to be awarded, we're covering the defense costs. That is where you're going to see the majority of the cost of the claim actually occurring, is in the defense costs. So we generally sell the policy as prepaid legal fees for this type of scenario at a great discount. The normal policy, depending on the number of employees, could run from $2,000 to $5,000 for 25 to 30 employee. So it's not a terribly expensive coverage, but the cost to defend, as we'll see on the next slide, is much greater than that. So the current trends in the marketplace show the most likely source of these claims are resulting from age discrimination and from retaliation. So basically, if you're over 40, you are protected. So most likely anybody in this room except for Todd, Brian, and myself, I don't know if anybody else maybe that's under 40, white male, you can't sue. Everybody else can sue this. So whether it's female, minority, over 40, but most of that's what we're seeing is on the age discrimination side, and also on the retaliation side. In Delaware, we've, just like in most of the country, we've had some very tough economic times over the last few years. Delaware was hit a lot harder than many states, and we saw unemployment, especially in the construction industry, creeping up to 25%. So what we saw happening, a lot of people when they were being laid off, is they would file a workers' compensation claim, comp claim gets denied, and see retaliations would come back that they were laid off not because they was laid off, they were laid off because they filed a workers' compensation claim. So we've seen that happen quite a bit. So that's just another one of those concerns that we really like to address by having this policy. That's okay. There's a 30 burpee penalty for being late. So. So this is where we get into what the defense costs. If this doesn't scare you, I don't know what will. The average cost to unsuccessfully defend an employment practices lawsuit regarding sexual harassment is $150,000. That's unsuccessfully defend the suit. So it is very, very expensive to have one of these suits to defend it, whether you're successful or not. It's still going to cost you a lot of money. So again, this policy may have cost you $2,500, and because you didn't want to buy it, you're out of your pocket $150,000. This stat always scares me. Out of 10,000 EPLI suits, only 16 actually win in court, and then are upheld in an appellate court. So a lot of these, and that's what prevents a lot of employers from purchasing this policy. They say, well, they're all BS, they're bogus, they're not real claims. You're right, they're not. Many of them are not, but you still have to hire the attorney, you still have to show up in court, and there are some significant costs that go along with those. So again, we really look at this as purchasing this policy in order to protect you from legal fees as well. Are there any questions on the employment practices and how it relates? Probably better off asking Jim than me. No? All right. We'll just touch on directors and officers liability as well. Directors and officers liabilities provide coverage for any type of suit alleging a wrongful act by a director or an officer. A good way to look at this is a management liability policy. It's going to cover the decision that you made. The general liability policy is going to cover you for bodily injury and property damage. It has nothing to do with the decisions and the actions that you make in your role of authority. So the D&O suit really debunks the theory of a corporate shield. Everybody is under the impression that we have an LLC, we're an S Corp, or a C Corp, we can't be sued. That is not true. So you are putting your personal assets on the line every time you make a decision. As an owner of the company, as an officer of the company, you can absolutely be sued as an individual. Whether the corporation is required to indemnify you or not, it's really up to the bylaws and everything say. But from that standpoint, do you really want to be sure that the corporation is able to indemnify you and is able to defend you? So again, just like the employment practices, we are providing the coverage for the damages along with the defense costs as well. So where are these suits coming from? Most of these suits that we see are coming from competitors, lenders, investors, and former or current employees. So a competitor may come after you for a violation of a non-compete. You hire one of their estimators to come in and they know all of your prior customers and they're going off of that. So we see a lot of claims from there. Investors and lenders, obviously a scenario where there's an allegation that somebody cooked the books, you got a loan by saying that they're playing around with the balance sheet a little bit, so that's what we're seeing that. And then current and former employees, we can see this type of stuff as well. The way the coverage works, we're going to reimburse the individuals in cases where the organization is not required to indemnify. And likewise, in scenarios where the organization is required to indemnify, we're going to reimburse the corporation. Another thing that we like to recommend is having a policy purchased for the individual. So a lot of directors, officers, owners of businesses serve on nonprofit boards, they may have a charity that they work with or spouse. And what we like to make sure is that again, they're not relying on this nonprofit to have the appropriate coverage. We like to purchase coverage that's actually going to cover the D or the O while they're working on not just the business side of it, but when they're dealing with some of these nonprofits as well. This is another scary example. Enron, everybody knows them. They had over $100 million in directors and officers coverage, and it didn't even cover the defense costs. Just to, again, keep in mind the costs of some of these suits. Questions on D&O, directors and officers?
I got one. Just John Fit. On the, if you're serving on a board of directors, if you're considered a commissioner or a director. I mean, so I understand this potential personal liability.
Absolutely.
Would you be looking at that entity then and asking the question of what protections in place,
If you're
where
on
the policy is?
If you're on a board, ask to see the DUNO policy, and you can send it to me, Mark, and I'll look at it for you.
So-
But absolutely, you want to ensure that they have directors and officers. When you're on your swim club's board, and the debate comes up whether to replace the fence around the pool, and everybody says, well, we didn't have a really good year, let's not do that this year. And then kids break into the pool, somebody drowns in the pool, they're coming after the board, they're coming after you personally because of the decision you made as a board member not to replace that fence.
Is that transferable, or does it have to be registered with each independent board member? Like, your name's got to be on the policy, or is the board in general?
No, it's covering the board, and what it does, it's going to cover any current board member, future board member, or past board member.
Right.
But then again, in that scenario where you don't want to rely on the pool to have the coverage, you can purchase your own policy that's going to cover Mark, whether he's serving on the YMCA board, the local board for his pool, Boys and Girls Club, whatever it might be. It will just cover you in that scenario that you don't necessarily have to worry about that board coverage. Workers' compensation, that's been quite a hot topic here in Delaware. In 2007, we had our first workers' compensation reform since 1917, which is when workers' compensation laws were actually enacted. The past 2 years, there's been a lot of debate on workers' compensation. We've seen some significant rate increases, a lot of things that have changed, and a lot of the perception on workers' compensation. We like to view workers' compensation as a tax on workplace injuries. It's not necessarily an insurance coverage where you're just passing the buck on to insurance carrier. At the end of the day, you are going to pay on those claims. The employer's cost is generally 4 to 1 when you combine the direct and indirect costs of what the insurance carrier will actually end up paying those claims. So again, having workplace safety, having safety committees, a lot of things that we can help to control is really a good way to control those costs. Many employers have the misconception that they cannot control the cost of workers' compensation. We've actually found that the one line of coverage, the one place that you can actually have the most impact as a company, as an organization, is workers' compensation by promoting a safe work environment. The most controllable pricing factor for workers' compensation is what's called the experience modification rating, which is a predictive model for future losses. So anybody that's in construction or does any big work, a lot of times if you're going on to a DuPont or going to work for a board, they're asking you what your EMR rating. It's a predictive model for future losses based off of previous experiences. And again, it's providing a credit or a debit over workers' compensation, so it's directly impacting those bottom line premium dollars. Any questions on workers' compensation? The last two are really going to upset you. So employee dishonesty. This is where we seek coverage for any type of embezzlement from an employee. Anybody that reads the news journal over the last few years, every few weeks or a few months, you'll see somebody else that's being arrested and incarcerated for stealing from their employer. This is where we get coverage for that type of scenario. It's not just dealing with money, securities, vehicles, equipment, materials. Again, anybody in construction trade, anybody who looks at some of the suits that are going on with some of these scrap shops, you see coppers being stolen, people climbing towers. I've had people cut through fences and saw the catalytic converter off of vans to get $20 a pop. So we're seeing these types of scenarios happening, and it's not just the outside criminal that's coming in, it's a lot of it's happening from within. And again, it's not going to be covered unless you have this type of coverage. So another thing that we look at in today's cyber age is it's not just the person that has the hacksaw and is cutting up the van. It's going to be dealing with computer issues such as fraud or funds transfer fraud, forgery, alteration. So they're hacking into your computer, your account is, and they're sending out checks in their own name, and you'd be surprised how much that actually happens. So accounting procedures and things that are in place for that. A lot of times when we're writing this type of policy, it's a sizable limit. The insurance carriers first will ask if the people handling money are required to take a mandatory 7 days off consecutive. The reason for that is generally when these people are called, it's because they get sick or they're out of work for a little while, somebody else has to step in and take over that accounting role, and that's when those are actually covered.
Do you have a limit on the policy, or is it cost basis?
It's cost. So every dollar that you add in coverage is going to add a dollar, not necessarily a dollar in premium, but obviously, yes, the higher the limit, rating basis goes for the type of industry and the carriers. Once you start getting up into $250,000, $500,000 in coverage for this, that's when the carriers are really going to start looking at your underwriting, the underwriting part of it. What are your controls in place? How many people are handling the money? Who has company credit cards? Are you reconciling? Is the same person doing all the statements? Scenarios like that. They really want to make sure that you have the procedures in place to help prevent this scenario. Generally, the only rule of thumb is $25,000 is the most anybody will generally take at one time. You usually start small and see how much they can get away with. There was a hair salon in Delaware where over 3 years there was $1 million embezzled. Just to give you an idea, that was a scenario where the person unexpectedly was out of work, and that's where they found that. So it wasn't one of our clients, but it was well publicized in the news. And so just to think that $1 million from a hair salon, what some of these corporations can have, we see this happening a lot with nonprofits, churches. We see it. It's not just the blue collar workers. It's a lot of time it's the folks that own the accounting office that they have a gambling problem. Maybe they lost half their 401k. They're starting to worry about this type of scenario. So those claims really can add up. Again, we can look to blanket the coverage, which would just cover an organization as a whole, or another scenario where there may be a controller, a CFO that has a lot of access and has check writing authority. We can actually schedule the coverage for an individual. So you may say, well, we're only worried about Joe Blow and sales up to $50,000, but we're really worried about a controller who has access to much more money. So we can actually schedule a separate policy out for that individual. And we can also extend the coverage to cover an independent contractor. In our office, for example, we don't have an in-house accounting person. Most of our insurance carriers do our billing. So we have 2 independent contractors that one comes in 3 days a week, one comes in 1 day a week, does our bills, does our financials. They have access to all of this, but they're not employees. So again, an unendorsed policy, it's called employee dishonesty coverage. It's not going to cover that independent contractor that steals from you. So if you have that scenario, or you're dealing with any of your clients that have that scenario, you may want to ask and confirm that your coverage has that in place. Since 2007, just my clients alone have had over $1 million in loss from them. The largest is $130,000 that I've had, so these claims happen quite a bit. Again, there's significant ones that in Delaware that are hundreds and hundreds of thousands of dollars, $1 million, but it's pretty common to see $100,000, and it occurs over years generally. So again, it's not just the one-time theft that those usually get caught where you, the person that's using the gas card. We had somebody that was going to the gas tank and literally waiting at the gas station until someone went to fill up. They would use their company card, fill them up, and take cash from them. And that those get caught. Those are $4,000, $5,000, $6,000. But over time, over 2 or 3 years, you can have a significant amount of money taken. Any questions on employee dishonesty? The last part we're going to talk about is privacy liability. In our industry, it's called everything from privacy liability to secure data liability to cyber liability. It's really an ever-evolving coverage. This is something that we are highly recommending to people. I know Matt's going to talk a little bit more about the real-life threats to you. Just to talk about the coverage side of it, we are looking to cover the breach of a client or customer's private data. So we are looking to cover anything from the first party and the third party aspect of it. So it's going to cover your clients, your customers, but also your employees, your own data. If somebody downloads a virus and it eats up all of your data on your computer system, what's the cost to recreate all of that? We're covering all of that as well. So credit card, bank account, medical information, these are just some of the examples of the records that we're looking to protect. We see a lot of claims for this type of coverage from schools. We see a lot of this from medical, whether it's a doctor's office, dental offices, a hospital. We're seeing a lot of this area. We just look at the records that they have on Obviously, they're having social security numbers, which tends to be the number one identifier that we're seeing stolen. But even things like zip codes, credit card information, the last three on your back of your credit card, all that information that so many people are asking for. You sponsor an event and you're emailing them copies of your credit card front and back. My wife and I, just to give you an example, went to Las Vegas a few weeks ago and she wanted to go see Elton John. So I purchased tickets from a ticket broker in Las Vegas. He called me and said, I need you to send me a photo ID, copy of your driver's license front and back, and a copy of your credit card front and back. And they wanted me to scan and email it to them. And slapped them and said, I'll buy tickets from somewhere else. And they seemed really surprised that somebody actually fought them on this. And they ended up still giving me the tickets. But how many people are just emailing copies of their credit card and copies of their ID? That's all you need to really steal an identity. In this type of policy, we are covering the costs for damages, defense costs, and the cost of notification, which I'll touch on right now. So when one of these scenarios happens, Ed at Children's Hospital had it several years ago, Target recently, TJ Maxx about 10 years ago, Brandywine YMCA about 15 years ago had this type of scenario. We have to provide notification for every record one. I just looked this up this morning. The 2014 United States Postal Service price for sending a certified letter with a return receipt is $6.48. So if you have 100 customers, 1,000 customers, 5,000, 10,000, you can see just the cost of notification can be substantial. Another thing that you're required, a LifeLock type of product for credit monitoring. So to provide LifeLock for 1 year for 500 people is going to cost an estimated $16,000. So you're on the hook for $6.48 per person. 500 people, you're looking at about $60,000. And then we look at what Target was. Target, everybody knows about that breach. Just in the fourth quarter, they had $61 million of expenses related to their breach. Their profits fell 46%. So if your business or your organization has this occur, it's not only the direct costs of it, it's not only having the scenario where you have to pay $6.48 for every single person, or provide the LifeLock service as well. You're also looking at the impact to your business. And if it can cause Target to lose 46% in 1 quarter, what can it do to your business? Another part of the coverage that we look at is business interruption, business income coverage. So when this happens and your profits are going down, we can tie it to this breach where it's actually able to reimburse you for that lost revenue. So these are scenarios that we really, really strongly recommend this. 2-3 years ago, if you didn't have a website and you weren't doing e-commerce, there was no need for this policy because it wouldn't respond to you. Now, even if you don't do anything electronically, even if you just keep paper files of everything, if the janitor steals it, if a disgruntled employee steals it, all of these scenarios is where we're covering this, again, for the first and for the third party. It's really something that I highly, highly recommend this.
Could you go over the kinds of incidents that would trigger having to get LifeLock protection for people?
Sure. A lot of you're going to look at a data breach. Maybe a decade ago, got a letter from Ed at Children's Hospital. I went there, I had a concussion from football. And I got it, their records were breached, somebody had access to it, they didn't know of mine, and I never had anything come from it. But I got LifeLock for a year, I was notified, so those costs for every one of those. Brandywine YMCA, I was a member there, my credit card information was breached. Nobody ever took it, nobody ever used it, but just the breach, the fact that your data may have been compromised is what triggers that you are required to provide this.
So what would that breach look like? Is it because they were hacked, or is it because they had let these stuff out one day and they don't want someone to look at it?
It could be either.
So how do you determine as the company whether you think there's been a breach? If you lose some files in place, you walk back, you come back, and you're like, oops, I left that file there. Is that enough of a trigger, or how do you determine whether?
Yes, when the loss from the insurance side of it, yes. Just having that data, when that data is compromised, when it could have been compromised. I know a financial advisor that had a portable hard drive that he had all this information on, lost it. Doesn't know that it was stolen. Doesn't know that anything happened, but he lost it, it was compromised.
So it's a self-determination of the companies whether whatever's happened is.
That's when the carrier is to be put on notice, and the carrier starts to work with you and does some research. So it's not just right then and there, blanket, we have to let everybody know. But that's really when we want the carrier to be notified, when that breach occurs, when the potential for the claim exists. And then obviously, yes, if you're able to determine that nothing was breached, then you're fine. I can't tell you how many times my wife has shot the target in the last year, but we've had no issues with it. But that opportunity is still there. Obviously, our data potentially was breached.
And one last question. What if in the case of like cyber hacking, you don't know there's been a breach? At what point are you liable for potential for customers' data being stolen?
When you take it.
So
When you take the data, take example, a lot of the charities today, they think by using a PayPal service to take donations, they're exempt from this. The liability arises with the person that's benefiting from it. So yes, when they click on Delaware Economic Summit and you go to enter your credit card information and you're actually entering it through a third party, through a PayPal or any other of these third party services, most people are thinking that, well, this is being exempt. We're exempt. We're not actually taking the credit card information. But when you're benefiting from it, you got to believe that you're going to be sued. And again, this is where you're looking at these costs. Any other questions on this? No? I'm going to go ahead then and turn it over to Matt, who will probably scare you more than I can.
Thanks, Dave. You just gave the reason why there's good job security in the fraud space because of what's going on, and I'll get a little bit off topic of just to kind of relate some of the things that John just went through. So I've managed between Citi and Bank of America. I've probably been in the space for about 15 to 20 years and managed both on the large commercial side of the fraud space as well as on the consumer side with most of my time being on the consumer. And I can tell you it's a very odd conversation when large commercials had a $100 million wire that's out the door and they think that an insurance claim or something is going to cover that, or that the bank's going to indemnify, since on the consumer side you always have zero liability. You're going to get your money back. That doesn't exist in the commercial space. So those are very awkward conversations, and what he was just talking about becomes very real to somebody very quickly when you're having that conversation. But as far as on some of the data breaches, within the banks, we generally know about these breaches long before they hit the press. We have analytics that look at this constantly. We're at any given time looking, and we would suspect probably about 1,000 breaches that are going on actively. We certainly can't say anything because then we potentially could really hurt somebody's brand. And I think that becomes, fraud's becoming, and I'll give you some numbers. These are scary numbers, but they're becoming somewhat baked in at cost of doing business. For the most part, these are getting fairly flat. It's the brand risk that really has a lot of people scared. I think that Target's a perfect example. If you really look at the actual amount of fraud that Target gets, it didn't necessarily rise that much, even for the large financial institutions. The numbers aren't that enormous that you think, wow, this had huge financial impact. But I think the brand risk and their profits going down 1/4 by almost half, those are the kinds of things that have a longer impact of it, because then people really lose trust. But in the fraud space, I also want to kind of hit on some of the internal fraud just to give some idea. The going industry assumption would be around 25 to 30% of total fraud cost in the industry is due to some level of internal fraud, either internal to banks or internal to the businesses that are running that. The overall number for fraud in the industry for financial institutions and insurance, they would assume that that's about $3.2 trillion a year. So if you think about that, 25-30% still becomes a very meaningful number. And I've had cases involved where in the bank, same type of thing. You have somebody who's maybe working in your procurement group, making up bogus suppliers and making payments to themselves, and it goes on for years and years and years. The last one that we found, she finally went out on maternity leave. So that's how you find it. So when you don't have some of those controls, and the controls become, in some cases, it's very important from a financial perspective, but what's becoming even more for an internal fraud, especially with cyber, is people getting access to how your systems works, where your controls are, and leaking that information into the fraud community. I was in Las Vegas at the Merchant Risk Council 2 or 3 years ago, and there was a lot of the folks that work in this space. They have connections into the kind of criminal underground, the hackers, that community, and there was a guy who, very notorious hacker, and had been coding virus software for a very long time. He was at the conference, and they arranged a meeting for him and I. I didn't know what his name was. He didn't know what my name was. He knew I worked for a bank. I knew he was a hacker. They kind of just left it at that, and we went and grabbed some coffee. So it was really interesting. And so I'm sure whatever his name was wasn't true, because I saw when he was fumbling in his bag, there were like 6 passports in his bag as it was. It was kind of eye-opening, the conversation, for a couple reasons. One, I was kind of like, how do you come to conferences? Like, wouldn't that kind of give you away? And he said it's total anonymity. You can be completely anonymous because his identity is purely online. Nobody knows what he looks like, what he does. I mean, that's just pure. So they can interact quite a bit, and go without notice. The other thing is he started to describe to me how it's set up. And it sounds like any other large technology company. They have a helpline. They have, QA process when they have versions that are sitting out on the shelf, just waiting for. They purposely don't want to ever introduce their latest and greatest, because that gives financial institutions, businesses, etc., the ability to go out and put in controls, around that. So this was 3 years ago, and he said they already had viruses up for the iPhone 5. Which was interesting because, iPhone 5 wasn't, for the most part, even thought of, but it just gives you the intel. They have people that work at Apple that are feeding them information. And so it's a very interesting community in and of itself. The other thing that I asked him is, I said, so how long does it take you guys generally in this community we put out the latest and greatest, anti-fraud or anti-malware type of solution? How long does it take to break that? He says, generally, a week. He says the really good ones, 30 to 90 days. So I started to think in my head, I said, okay, for me, at a financial institution, to go put a business case together, get the funding, implement it, test it, etc., 12 to 18 months is what it takes for us to put something in. And so, by default, we're behind, years at a time for this community. So, so really there's been a pretty big movement. So when we talk about data breaches today, a lot of it is focused around credit card information. That becomes what's valuable to the fraudsters. That's going to change significantly next year when they move from, when they introduce the chip, liability shift between merchants and banks. So we think that what breaches look like today will be dramatically different from what they're going to look like post. And if you kind of Google and go around for any country that's been through a chip migration and look at their loss curve, you see the 12 to 18 months prior, you see a huge increase in fraud use, because that asset's going to become non-valuable here shortly, because the mag stripe won't be used and everyone will be really moving to chip. So we think the next 12 to 18 months, especially for businesses, you're going to see a huge increase in the amount of fraud that's coming through, because they're going to try to use these assets and still get some level of value. So we think roughly that's about $25 billion is what we would say is counterfeit or because of the data breach today. So the other piece of that, I think of, one thing, when you introduce or make a large change like what chip card will do to the industry, the frauds don't all go to college and get legitimate jobs. I mean, they just find other ways to go around. And so we think there will be, a fairly big shift, $25 billion that is in the US, that I think some of it will move out of the US, because you've seen the UK and Asia have very, very low loss rates compared to the US. So we think some of that will shift back to those countries. We also think that it's going to really make a fairly large shift to small businesses in the commercial space. That's been a place where, one, companies don't they don't talk about fraud much, so it's something that's just unheard of, and again, back to the brand risk, they saw that there was a lot of potential issue there. But most of the large financial institutions, Citi being one of them, we're moving about $1 trillion a day in money movement for small businesses and large commercial. So you have, lots of room for potential issues. They said there's roughly, I think that the latest graph says 1.5 million new strands of viruses that come out each year. They're saying that 60 to 70% of what's coming out is targeted around business and in the commercial space. So that rapid amount of movement and the ability to react to that becomes incredibly tough. So we've seen over the last probably 4 or 5 years a huge increase in the amount of investment that companies are making and banks are making relative to this commercial space. Because I think we'll see a fairly dramatic ecosystem change relative to payments, and something we were talking about outside with some of the Bitcoin and money movement, and all of the businesses trying to make it quicker, easier, faster. So you're going to see mobile payments in 2010, I think, made up about $10 billion of payments. They're expecting that by next year to be $550 billion in payments. So you're seeing a huge movement. Again, it's to make it easier. That also allows easier, fewer controls in the fraud community. And so we're really, it's getting less about point-in-time solutions. And so the idea here is how do you start to remove data out of the payment channels that becomes useful for these types of data breaches. So a lot of times being spent around the authentication piece, because we are going to significantly change the way people can move money around. That also doesn't give us history. The credit card business has been monitoring fraud for a very long time. They have very mature models that are highly predictive, and it's where everyone's running around 5 to 7 basis points of your total sales and it being fraud, but that's become somewhat of what we feel is a manageable number. But part of the reason you can do that is because you have a lot of good models, good history for a very long time that allows you to do that. Now we're giving channels for consumers to move money around in ways that we've never seen before. Everything looks like fraud. I mean, a very large oil company used to hit our fraud rules all the time because it looks like fraud. They're moving money, huge amounts, different times, all over the world. And so we're trying to get away to say, how can we authenticate and feel comfortable that this person is who they say they are, and then let them transact the way they want to at that point in time. To really kind of move to that type of consumer experience. So it's really around authenticating people, less about authenticating transactions, which is going to really change this whole fear around data theft into a different it kind of will flip it upside down, because you start thinking about biometrics. Lots of people have been talking about that fingerprint, iris scans, voice biometrics. But then what you start to do is you start to introduce non-perishable data. Today, there's a data breach. I can send you a new credit card. You can go get a new social security number. You can get a new email address. You can't go get new fingers and new voice and new irises. So when you start, so it starts to say, well, that seems to be very secure from that interaction. The availability of some sort of data proliferation becomes that much more of an issue. Banks are probably going to spend, there's different metrics, but, and then some of it's just how their investment plan's been done. But the largest expense that banks are incurring right now is information security, data security, and trying to keep within the 4 walls. Even if, and take Target as an example, Target, for the most part, didn't get breached. Somebody didn't go in and steal stuff from Target. It's their third-party processors. It's the folks that they were doing business with. Even, and there's been tons of regulatory and compliance work to say, you can't store the data that got breached by Target. Well, obviously you can. So there's a lot more and newer constituents in the payment ecosystem that you've never really thought of. So now you have people, the phone makers now, they are becoming a huge player in the payment space because that's the vehicle that you're going to be transferring. that has to be taken into consideration. The chip that's in your phone, that's a different manufacturer. So you're starting to go around and say, how do you really protect and do this? And again, it goes back to authentication. So the interesting thing is, while it generally sounds very scary to say, I can go on my phone and move, $100,000 tomorrow, but what we haven't necessarily taken into consideration is, are there security features now around that phone that I can utilize that I used to not be able to utilize? So biometrics being a good example. The biggest issue with biometrics, any kind of biometric, is the enrollment process. So how do you get people to enroll? Citibank would be a good example. We have, the largest amount of credit card users, however, very small network of branches that are really focused to the large cities. So how would I get people into a branch to take your fingerprint or something like that? Bank of America would have a much better distribution channel. So there's logistics around that, whereas a phone now becomes a way that I can potentially start capturing biometric type of information. So as technology is changing and the risks are going up, it's also giving us a chance to really look at technology in a much different way. There's a very interesting company that's come out with, they did some scenarios that they would make your mouse disappear, the little point deal, and they said it was amazing how predictive what your reaction is once your mouse disappears on your screen, because everyone kind of shakes the mouse and it does that. And they were doing it, and there was a lab, and it's amazing. It's almost like a biometric, because the way my arm movement is much different than yours, and it became almost a unique identifier. So there's things like that that are becoming investments that, again, that's becoming much more interesting to me than how do you go out and start trying to over-regulate, the payment space to say, here's what data you can store and can't store. I think that's a losing battle for cybersecurity as we know it today.
You both made me scared about third-party vendors. So is there a way as a business to, is there a litmus test? Do you have to be with a third-party vendor to have a sense of how much they are on top of these types of issues that will limit your potential for problems?
So I'll start with that. Third-party vendor risk is probably, if you look at overall operational losses and that have to be covered as far as the new capital requirements for Basel, third-party fraud is becoming, for all financial institutions, the largest issue, and that's where they're looking at. It's probably in the papers you see it's probably the most reported on risk that the financial institutions have, and so there's a few ways that we've gone around it. One, it was kind of seen as the third party, they own the risk, so it was all about how do we indemnify against ourselves. But again, back to the brand risk. Nobody went out and is yelling at the company that Target used that lost its data. Nobody is. Everyone's yelling about Target, and that's what's on the front page of the news journal. So those are the reasons why there's so much more of a focus, so much more of a due diligence, and it's been less about identification and much more about how do we really start to manage, how do we have a QA process to understand what they're doing. There was a long period of time where third-party vendors, nobody had ever gone there and even looked to see if there was a third-party vendor. We've had some small business fraud cases, and mortgage crash did this as well, where we were writing loans on houses that didn't exist. We were giving small businesses that were set up as a hospital, and then you can now go on Google Earth, and it's somebody's house. So there's that level of due diligence now is so much higher in companies, and has to be the same for merchants because it's your brand that's on the risk, not theirs.
I think just to touch on that, you mentioned that looking at being indemnified by that merchant is really a value part of it. And the insurance guy is evaluating what their insurance is. If you're hiring somebody to drive for you, you're making sure that they have auto insurance. So if you're hiring somebody to secure your data, are you making sure that they actually have the coverage? Because you can have the indemnification agreement in place where they have to indemnify you and defend you, but if they don't have the funds to do it, guess who's the buck is coming back to you anyway. So if they don't have the proper insurance in place to actually be able to indemnify you, because they most likely won't be able to spend $61 million that Target had to spend in the fourth quarter alone, it's going to come back to you anyway. So it's really just managing and selecting the right partner. My guess is that Target probably was working with the best of the best. I don't know who they were working with, but I'm sure they weren't working with some 17-year-old kid in space. It was, I would imagine, a very reputable company that had a great ability. But if it's taking you 18 months to develop and it's taking the hackers 30 to 90 days to hack it, it's really a losing battle. And it's not just the worst case scenario, it's also a likely scenario. So it's really what is going to happen, having the damage control already set up. And if the idea is that, well, if it does happen, we want to make sure that it doesn't come back to us, that it goes to them. It's making sure that they have the proper insurance in place. It is another part of that is going to be that your reputation is going to be damaged. It's making sure that you have the coverage in place so that you have the funds to put out a marketing blitz and go out to everybody and let you know that your data is secure now. You've made these changes, and by having insurance proceeds, it helps to helps with the cost that you're going to incur, because most likely it's going to happen.
Anecdote on that, the guy from, I think it was LifeLock, who used to put his social security number on the side of buses and those types of things, he ended up getting hacked, but he said he couldn't. And what ended up, the value change out of that, what happened, it was a third party that LifeLock was using that ended up getting the controls were able to be circumvented. So it's, the frauds are very ingenious that way.
On the merchant side, we take credit cards for less than 1% of our payments, but others in the room process a tremendous amount of credit cards as merchants. What are some of the best practices that they can use besides having very good insurance coverage in the event of a breach, but to prevent a breach from happening in the first place? What are some of the things they can do to maintain data security?
So I think one is, who you're using to really do your processing, who's that third party that's sitting behind generally the acquiring bank, and what you're doing. The due diligence there is really important. And in the case of Target, it was malware that was actually on the merchant terminals. So again, having that QA process to really monitor that, and that's what happened with Target, is they hadn't done a QA on their merchant terminals in a very long time, and that's why that had been sitting in there. The other piece of it is just making sure that as you're looking at those terminals, that they don't look like they've been damaged. A lot of them, it's kind of we've done some forensics around some of the smaller merchants that have been that end up becoming a point of compromise for cards. And if you look at the terminal, it looks like somebody threw it against the wall and stepped on it. That's kind of obvious that somebody may have done something. That some of these that they're not overly quiet about how they went around that. So simple observation. The other piece too, we see this a lot in gas stations, where somebody's set up a camera and they're actually watching people, and that's how they have a skimming device on the terminal, and then they have a camera that's capturing what the pins are. So some of that simple observation of just your actual physical location helps with that as well.
You had mentioned that there's going to be a shift next year in risk liability from the bank to the merchant. Is that going to?
Or vice versa. It could happen. So, and what's going to happen? So, most of the banks were saying that will probably be about 85% complete, meaning that you will have gotten a new card and it will have a chip on it now. And so the new liability will be if I'm using a magstripe because it's an old card at a merchant that has a chip-enabled terminal, bank takes liability. Opposite way, if the merchant is still using a magstripe terminal and I have it and I'm giving them a chip card, merchant owns liability.
But that won't affect e-commerce at all, though. Will that also affect point of sale?
Which is that $25 billion of fraud today, a ton of it's going to go to e-commerce. That's what happened in the UK. If you look at the UK's chart, it went from skimming or counterfeit type of activity to just a complete flip-flop. It all went to card not present. So e-commerce transactions, and it also came to the US. So what was happening is, since the US doesn't use chip terminals, any of the large issuers were still had a mag stripe on their cards because people travel to the US and would use it here. So they would take cards from Brazil or from Colombia or UK, come here, counterfeit them and then use the cards in the US. So we think that migration will be some to card not present, some will go back to some of the countries that the US ended up taking some of that liability. And then I think the other place is going to be to small businesses and corporations.
Is there any difference between picking credit or debit, aside from the standard you're talking about again?
You mean as an acceptance method?
As a consumer, I mean, you accept more risk as a consumer by picking credit or debit.
So the real difference there to the frauds, card data is card data. I think generally people will have a higher credit line than maybe what they carry as a balance in their checking account. So there's some of that issue. When we talk about data breaches, the kind of holy grail for the fraudsters is to get the magstripe data as well as your PIN, because that turns into their ability to go get cash, which is obviously the preferred fraudster. So you're not necessarily taking any more liability from a consumer side. I think that it still says in the Visa and MasterCard rules that consumers are liable, up to $50 or something like that. All banks have gone to really zero liability. So as a consumer, you're not taking on any incremental risk. I will say the way most consumers look at it, when you steal money out of my checking account, that became really real to me because that's my money. When you steal money off of my credit card, they think, well, that's the bank's. And so, there is a mind shift there that I will say the impact of a fraud event on your banking account generally is much more passionate. And a lot of times you'll get, people will leave, or you'll get some attrition there. The card space has become, I'm not sure if I mentioned this, I think over 2/3 of every credit card in circulation has been in a compromise or a breach. May not have been in the news, but it has been. So I think it's almost becoming somewhat, people see that credit card as maybe a preferred risk avoidance type of channel, as opposed to, they keep their debit cards a little bit tighter.
Do you use credit or debit?
Do I?
Yeah.
So I was a huge debit, and by the way, I'm the worst example. I do everything online. Most people say one PC for your banking, and then do everything. I bank on my iPad all over the place. So I'm a terrible judge of what you should do as a worried consumer.
We should do the opposite.
Yeah, do the opposite of what I did. In fact, I've had so little fraud. I was in Japan doing with a visit with the team, and my card got skimmed at a hotel, and then was being used a day later in South Florida. So even with me and I travel all over the world, but I used to use debit, and then for pure mile reward points, I went to credit, but nothing as an informed decision.
Okay. I had my card skate to the beach last year when I was just there, and I don't think I used it. I think someone on the beach when we were in the water. Something to it. I used it in Rehoboth. So the chips are going to prevent that type of.
Yes, for the most part, that skimming will go away. There's already been cases where they're able to take the chip off of one card and put it on another one. So that technically does the same thing. Because they're starting to use dynamic chip activity now, that won't work because it won't match with previous usage. So, and that also looks really odd when somebody fishes a chip out and puts it in the note. They haven't got a good way of perfecting that. So that, for the most part, will change that. And that's that 25 billion that we would estimate in North America that will go to different channels.
So you can't run up a giant bill at the starboard and say it wasn't you anymore.
So what you're saying is you're expecting an increase in online cyber.
100%. And in fact, Google the UK chip migration, and it shows it's literally like they just flipped the graph upside down. So card not present was down here, and it immediately went to the same level that skimming was at before. I mean, it was a migration within, 90 days.
Where there's a will, there's a run.
Yeah, absolutely.
How long has the chip been used outside the U.S.?
For quite a while. I would say 10 years is when they first started going. And North America has really been the hinge point for large, where there's high usage of credit cards. We know that there's going to be some countries that still will not be chip enabled, but not many people are willing to go to the middle of Africa to now do their credit card fraud. So we think that North America was kind of the last hinge point to see really a pretty dramatic flip in the fraud kind of ecosystem.
Why did the U.S. wait so long?
It's expensive, and it's especially expensive for the merchants. I mean, going out and replacing all those, you're replacing all the terminals. They said roughly the expense, non-fraud related, the expense of doing the chip migration between the plastics and all the merchant terminals is $1 billion. So that's a huge expense for the most part to get minimal value. There was a kind of a conversation where the UK was really pushing the US to go there because there was still fraud occurring on their cards because the US hadn't gone there. And the UK's total loss line was $300 million, or maybe even under that. We were like, fine, we'll pay for your fraud. It's still 3 times cheaper to actually put all the terminals and re-chip the whole deal. So Visa, MasterCard finally put a line in the sand and said, look, October 2015, that's when we'll do the liability shift. So everyone's working towards it. I think Walmart right now is already 100% chip enabled in their terminals. That was part of Target's announcement that they were going to be chip enabled. In fact, their Target card, they were going to go forward, which by the way is a PR only move because until the liability shifts, the financial impact doesn't happen between the banks. So I have an Amex that has a chip now, but it adds no value unless I'm outside the US.
Right. I have Wells Fargo with both chip and
MasterCard, yeah. And so that was the other question that came up, is most of the areas outside the US have gone to chip and PIN. So you put your chip in and then you put in your PIN, which which really reduces the lost stolen impact. I find a card, I can go out and use it today. If it's chip and PIN, I would have to know the PIN number to make that card value. The US is going to chip and signature, so that lost stolen activity is still, or that risk is still out there. I can find a card and put it in and then sign, and so there's still that risk. That would be the only difference what the US is doing versus the others, and that became a expense play, really. To add the PIN activity was an incremental expense that the networks didn't take on. And to be honest, the PIN, it's another piece of static authentication, which becomes little to no value really to have that static information.
Is the PIN embedded in the chip?
Yes, and you can't even make it to where it's dynamic.
We have time for one more question.
Is the chip expense fed back to the cardholder's invoice, or is there no charge?
How do I answer that?
Yes.
There's no incremental expense. You're not going to see anything that says, you got $5 for the chip. I mean, I think in the economics, everyone knew they were going to have to go through this expense, so it was counted somewhere. So it's either, counter revenue to the banks, or it's fed back into, some other channel. Nothing's free.
I'd like to thank our two panelists, Mr. Powell and John.
And Mr.
John for joining us today. And thank you all for coming. Thank you all.
Thank you.